Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop from Pure Property, back in the studio as we round out 2025 and look down the barrel to 2026 and what's it all mean. And I've been talking about this a little bit over the last couple of months. It's certainly a topsy-turvy market at the moment, and whether or not that's a official property terminology or some sort of Phil Tarrantism that doesn't make any sense, I'm not too sure. Luckily, I bring people into the studio who actually do know what they're talking about, and one of them is Paul Glossop, the founder and director of Pure Property. We're going to pull apart the market right now and work out what's going on and how you can take advantage of it. And that's the game as a property investor, orientate yourself around what's happening in markets, taking a position, orientating yourself around it so you can actually take that position and then do something about it. And right now, there's lots of moving parts, but what I would say is that there's a lot of upwards positive pressure on prices at the moment. So if you're thinking about investing in property, it might be the right time to do that. No doubt you would agree with that, Paul Glossop from Pure Property.
There hasn't been a bad time to buy in the last 50 years, Philip. It just depends on when you sell is when you measure your level of success. And we're going to dive pretty deep into that a little bit later in today's podcast. But thanks for having me, mate. And,
mate, this is your show. They just roll me out to,
it's true.
To talk to you about it.
Still don't really know why. I'm surprised there's not someone better and more talented in this building. But lo and behold, here we are again.
And don't worry, they've looked.
They have.
They've looked. But,
not very hard, evidently.
And one thing, we're really struggling with dwelling approvals at the moment, but I reckon approvals for property podcasts are skyrocketing.
They're up. There's not many people at the helm vetting and rubber stamping the approval process, though. The applications, they just keep coming, and there's just a yes.
I don't know. We've been doing this for a while.
Mate, I'd like to think that people have heard our voices for a long time, and if they've passed on this, it's probably via a recommendation from a friend. I actually had a text message from a friend the other day who was on a WhatsApp group chat with some buddies, and they live down the coast of Sydney. And the group chat was centering around, hey, thinking about buying an investment. Anyone got any heads up ideas about what's going on in Dapto? Anyway, that thread, and I wasn't in the thread, but the thread sort of ended up about 20 messages deep. And then it was a recommendation by someone who wasn't my friend, but a friend's brother who I don't know and is not a client of mine, but said you probably should give these guys in Cronulla a call, Pure Property Investment, and he sent me a screenshot. I was like, oh, that's nice.
Isn't that
just
nice?
Hitting random feeds.
Well, we picked Dapto, didn't we, in the Fast 50?
Was there a while ago, but it wasn't necessarily say we recommended Dapto, but it sort of led to saying...
That's what the numbers said.
The thread was more or less saying, boys, do you realise we're all just musing over stuff we have no idea about? Maybe someone should speak to a professional about it all. And that's where Pure Property Investment came into the conversation.
Well, there's lots of professionals out there now.
Well,
and they've all got podcasts.
Yes.
And they're still out there. Some are still out there sort of peddling this idea of circumnavigate serviceability by trust-based lending. There's some people still out there giving it a red hot crack.
This time next year, Phil, I think that'll be hopefully, and I think it's on track to become a far less used loophole and far less probably utilised conversation on podcasts about how to build a 50 million property portfolio.
Yeah. Well, we spoke about this last time we got together, and you were like, most of your client base is still buying in their personal name.
Oh, right? Vast majority. Vast majority. I'd say a good 80%. 80% plus, and it's not for any other reason, isn't it? It just makes sense.
Yeah.
And if it does make sense to go down the other alternative pathways, first and foremost, get some advice from your accountant.
Yeah, you need a good accountant. They're important.
They certainly are.
And you got to be really conscious of who you're listening to, particularly in the current market. And I need to be careful not to be overcritical of some of the decision-making happening amongst our bureaucrats at the moment, but I would go so far to say that there's a lot of policy being made on the fly for the purpose of potentially short-term vote winning, which is going to fundamentally compromise property markets into the future for some people.
Yep. Phil, I've got a feeling today is going to be you getting your bag of coal out and really layering into the bar humbug opportunities, and the Christmas Grinch is going to come out thick and fast here. So look out if
you're the property Grinch.
Yeah, absolutely.
Look, what I'd preface any conversation with. I'm very conscious and considerate of the great work and the calling that a lot of people find in political circles.
Yep.
And what I would also say is that we have some very talented people working in our public service.
Yeah, absolutely, mate. I come from a long lineage of public servants, and it is what it is. But unfortunately, you sign up for being in the firing line of being, essentially criticised on decisions. But there's a lot of things I find that happen in politics, which genuinely you have to have a 50-50 approach as a voter and a taxpayer of Australia to say, how the hell were they supposed to know that was going to happen? Like, some things are pretty hard to figure out until they happen. But other things that I think we might lean into, I tell you, you look at it, you're like, how the heck does it need to be explained in 20 different ways for someone to explain the fact that you give people the ability to use less money to buy property quicker, that it's going to push prices up when you don't have the same amount of supply coming to the market. And then additionally, you have more people coming into the country via migration who are skilled workers who can borrow money very quickly as well. It's not complicated, and I don't think it needs to be any more complicated than those 3 points that I just brought up. Now, lo and behold, people are trying to justify why it's done and et cetera. And we talked about this off air, that there was an election decision or a promise via the government of today that talked about the fact that this 5% first home buyer deposit scheme was going to be an election promise. Now, we talked about the fact, how many votes do we really think that influenced? I don't know. I mean, it's hard to, and you'll never know, right? But you're trying to win over the young voters, obviously. Yeah. And what that's done is the intention of this promise of getting home ownership as a dream into reality, and to get more people into homes quicker. Now, that's great, but it doesn't address the home affordability component. We've talked about this for months, if not years, the fact that affordability is a mechanism of supply versus demand. Now, you can address demand, but that doesn't address supply. And here we are, prices going up, particularly in the lowest 25% quartile.
And I've got to call it out, right?
Yep.
The great Australian irony for property investors, right? So what we're doing here right now, we're going to spend 45 minutes talking about all that's wrong with property markets.
And go buy more.
Seriously, like all that's wrong with property markets, and no one ever talks about this stuff, right? But let's and I could talk about this because I'm just a punter, right?
Yep.
The great Australian irony now is everyone will sit around and talk about housing at all levels of society, right? But government all the way through to chatting with your taxi driver or your idiot mates at a pub on a Saturday, right? Everywhere, right? Everywhere. Yep. Housing affordability is horrible. It's really, by the way, housing affordability, you go back through 50, 60, 100 years.
It's been horrible.
It's always been the same, but I'm not going to even go there, right? Housing affordability is the worst it's ever been. Young Australians can't get ahead because they can't buy their own home, ... All the stuff impact around that. Because of that, people are delaying life choices. They're getting married later. They're having less children, etc. Right? It's all bad. It's all grim. We're property investors, and the fundamental thing, universal, with property investors, they're all very different from all walks of life. The one universal thing that they all want is capital growth. So the great irony is we want to keep prices lower and more affordable to continue to build this utopian dream of Australian home ownership. However, property is an investment vehicle for people, and people invest in things to make money out of it. So this is the great irony. So, you can sit there and you get a lot of hate because people are sitting there, talking about this sort of socialist ideal of everyone gets everything.
Yep.
And then you've got this cadre of investors out there making money through property who want property to go up, but they're at the same time armchair socialists or champagne socialists saying, no, we've got to fix the housing problem. And you see it all the time, how many politicians are property investors, right? Quite a lot of them, right?
Yep.
So there's just this big irony connected with it, which I find really intriguing. And largely every single person is compromised. Government's compromised. Yep. The banks are compromised. Individual investors are compromised.
The system's compromised.
You can't have both. The system is the system. Structurally, this is the way things are built. This is the way it was
designed. It was designed to lend money to improve the essentially the float of capital to then keep doing what it's doing. And Phil, I'll probably go one further with that, is that we do talk about how to fix it.
Because do you really want to fix it?
But this is we talked about earlier. Like, we're not public servants, right? Yeah. We're not the ones who are devising policy because we want to make change. We're talking about how it can be made. Yeah. But I say it a bit flippantly because we've been doing this for 20 years as far as property investing and successfully really seeing multiple markets grow exponentially in value over that time. And word to the wise, it's happened the previous 20 years to that, previous 20 years to that, previous 20 years to that, and not just in Australia. Across the world. Now, the fact of the matter is we can talk about it, we can raise these issues, and we could get Albanese on this podcast today, and I could dare say we could talk to him directly about what we're talking about right now. Yeah. Is that going to make a change? Well, no, because I think you raised probably the one point there that I think is really factually never going to be possible, which is unless the government is going to fund the build of these dwellings in its entirety, you're relying on free enterprise and they need to make money. And the only way that money's made is by seeing a profit. And by seeing that profit, you need the market to be going in the direction that needs to foster profit. And that's a limited amount of supply versus a heightened amount of demand. And that means more credit goes in the market. That means that the superannuations, that all of those different aspects, they seem to continue to make money. The investors make money and people then continue to work to pay off properties. And we know the cycle is the cycle. So there is no policy about, hey, the government's, that 1.2 million target, the government's going to go and build 80% of those. Yeah. If that was a policy and they said, look, regardless of how they fund it, if they said we're going to fund it, I would say for me, look out, property prices are going to take a dive.
Yeah. But they can't afford it anyway.
Of course they can't. They never have been able to afford it. There was circa 10-15% of government housing back in the heydays of the 60s and 70s. That's dropped down to 4% now as all properties, and that's going down by the day. Yeah. They're privatising all the properties that were built for government housing. They're being sold off privatised to get more money back in the coffers. So how is this it's only going to be driven by private enterprise.
Yeah. 90+% of all investment stock in Australia is sort of private investors like me. Yeah. So the catch-all of this, don't hate the player, hate the game, right? Seriously. But I say this, and this isn't a comfortable comment for a lot of people, right? Australia needs to realign its cultural connectivity with how they choose to live. And we need to understand and appreciate, certainly in pockets of Australia, that you're going to have more renters than owners. And that's just a nature of the market we operate within and the world that we live in today. Yeah. Like this idea that 2/3 of Australians own their own home and or have a debt against that is not going to be the way that Australia's going to look like in the future. And we need to have a very honest conversation with ourselves as a nation and as people and saying, is this idea of home ownership a core fundamental value that guides us as Australians moving forward? Yeah. And that's what needs to take place. Politicians are way too scared to talk about this, right? Yeah. Because it goes against the last 30 or 40 years post-war, of what this ideal to be an Australian is. Like we've moved on and we've changed, unfortunately or fortunately, depending on which way, your bread's butter. But, if you go back 70, 80 years ago, and I'm probably going to get these numbers wrong, but it was about 50-50, right? Yeah. 50 people, 50% of people rented.
It's just been a diminishing and slow and steady decline ever since. And the irony, though, is that it can be argued, but the quality of life certainly hasn't diminished for the most in that time. As a country, we are not going backwards from a prosperity perspective, from a health perspective, from a schooling perspective. Exactly. So there is not a direct correlation to say home ownership all of a sudden means that you've got a happier, more prosperous, more successful nation either. And I think there is a generation of that Gen X and then the millennials and then everyone else coming before that, which probably is realizing that. And I've got countless clients now and been doing this for a long time, over a decade, with clients buying their first through to their fifth, through to, in some cases, north of 10 assets. I've got more and more clients who do not have a aspiration to own their own home. They have an aspiration to invest to make sure that their life is set up in the future. That's their aspiration. Yeah. How that happens is a bit inconsequential. It's more saying, I've got this amount of money, I've got this as my long-term goal, and I want to be able to invest, but I still want to figure out where I want to live. Now, I don't want to buy a home just for the sake of buying a home. Now, albeit this first home buyer 5% deposit scheme is going to push more people to do that. That is not really where the aspirations of the 20, 30, and in some cases 40-year-olds sit anymore. And that's okay. To your point, like, people prioritize, I want to send my kids to a school catchment that I think is more important. I want to live by the coast because I enjoy X, Y, and Z because that's more important. I want to be able to be close to a train line to then get me into the city, to my job, to restaurants, friends and family, because that's more important. There are so many different things that are driving those decisions. It's not because I want to have a 1,200 square meter corner block with my 4-bedroom, 2-bath, partridge in a pear tree with my picket fence, just for the sake of taking a photo out the front on Christmas Day. That's not what seems to be anywhere near as important as what it was, because it was a badge of honor post-war. Yeah. It was saying, okay, I've put my stake in the ground. No one can take this away from me.
Yep.
But I think we feel a lot more secure as Australians these days that we're not a generation. You and I haven't really gone through that wartime expectation. Most people investing in property now don't have that baggage of that fear of things being taken away. I'm not suggesting it's permanent, but I am suggesting that we don't have that memory. So I think, to your point, Phil, people are changing.
The different times back then, and
massively,
and you make a really important point around happiness, and I reckon if I could be bothered to do it, and I'm not, but I'm sure an AI robot could do it right now. If you go and listen to 10 years of me podcasting, I reckon I could find 40 to 50 times where I've told you so. I've told you so. This is what's happening. This is what's going to happen, right? What's happening right now is that we're setting up a generation of Australians for structural unhappiness. And you talk about happiness, right? This notion that owning a property will make you happy. Owning a property that you live in and raise a family will make you happy, right? We're not there yet. We're 1 month into this, 2 months into it. We've only got 1 month of data into this sort of expanded 5% scheme when anyone with a pulse, right, can actually get into home ownership, right?
Yep.
And this is the big bold scheme of the Australian government to do this. So you're setting up, not all of them, but I would say some of them, if not a lot of them, for structural unhappiness. When the realization, human nature, you're going to take the biggest loan you possibly can, right? Based on your serviceability. That one property, you've got to remember, most people only ever buy still one property, right? You're going to set yourself up with the most expensive home that you can afford, right? Serviceability wise. You're going to take a 95% debt against it. Now, everyone talks about the government being good people by backing LMI, so it removes a bit of cost from it all. So the government will guarantee the lender that the loan gets paid, right? You're in for 95%. You stay there for a year. You stay there 1 month, 2 months. It had a nice Christmas in it. When the reality of the world sets in 9 months, 12 months time, and the honeymoon is over and the shine wears off it, and you realize that you've got 30, 35 years to pay off this loan, right? Which is a big loan because you borrowed at 95%.
That you're responsible for.
That you're responsible for.
Not a tenant.
Not a tenant.
No tax deductions.
And then all the other stuff connected with it, things go wrong, the boiler breaks, this, that, and the other, et cetera, et cetera. The government chooses to tax you differently. You get laid off at work. You decide to have a family. You're down to one income. And interest rates go up. There's going to be a whole bunch of Australians saying, why did you sell me into this, Mr. and Mrs. Government, when really I would have been happier in the life that I had beforehand, even though back then I thought I was unhappy.
Yeah. And I had an alternative back then. And let's assume you're a Sydney-sider. Let's assume the first home buyer deposit scheme takes you up to $1.5 million. So let's assume you go and buy that $1.5 million home and you take out, let's just assume it's a $1.4 million debt. And you're obviously the caveat to this is you still have to service it. So a bank's not going to lend you money without your income showing that you can service it the same way you could in September before this scheme started. So if you did qualify, then your income's going to support that repayment. Now, to your point, Phil, you fast forward 6 months, 12 months, 18 months, life gets real. You might not have kids. You go into kids. You go from 2 incomes to 1 income, child support, daycare fees, whatever it looks like. There are things that happen in life. And as parents, you and I, of kids who have gone through different stages of life now, you know that kids don't get cheaper. As much as you think, you get them out of the nappies and into daycare, all of a sudden you go back to work. Well, that actually just incurs more costs. And unfortunately, there is a big, big trap here that we all fall into for the sake of raising a family. And I do vouch for the fact that having a family trumps the stresses that go with all of the other things. However, the financial realities are still going to be there. And the alternative to someone who's thinking about buying that home with the 5% first, the 5% deposit scheme, the alternative they might think, well, I had an alternative of buying a $600,000 investment. Yeah. I might even still only put a 10% deposit and pay LMI. But you know what? I'm still going to rent in that area that I was comfortable in. The rent was manageable. This investment is less than half of what I could have spent, but I'm going to start there and I'm going to get my big toe wet and I'm going to think, okay, how does this work? Am I comfortable here? Are we happier in this place? And building it from there. And that is the alternative that I see a lot more people take because they see the other side of the bridge. And for me, that painting that picture that you have, I think a lot more people need to take a quick dose of reality to think if you go down that pathway, not only is the reality of a big mortgage and all the commitments to it going to be real very quickly, it also stops you from actually doing those other things financially pretty much immediately. Yeah. So you're actually making a decision. Do you go one way or do you go the other way? Because it's going to be extremely rare that you're going to be able to do both in a short period of time. And a lot of people are choosing, well, not a lot of people, I think people are realizing that if you choose home ownership early via a low deposit and a very, very big mortgage as far as an LVR is concerned, you're not investing.
No, not for some time. And this goes back to this sort of utopic view that Australia still has around home ownership. We look at it through rose-tinted glasses, right? So, you know, you think of this dream of home ownership post-war in a nice place in the suburbs, picket fence, all the usual sort of soliloquies around it. Normally had one person working. Traditionally, the man went to work, the woman stayed at home and raised children. There was no daycare.
No.
There was no daycare because you had one income, right? And you could afford a house on that salary. You could have a car and all that sort of stuff, right? Who benefits? And you know, a lot of people, if you're a conspiracy theorist, right, you hear these things thrown around. Who benefits from younger Australians being tied into massive mortgages?
Is that it?
Ask the question, right? And,
Yep.
and the answer is, well, the banks do.
Of course they do.
You know, but then the banks benefit from it. All those people with large superannuation funds benefit from it, and most people hold their super in industry and retail funds, right? That's all good. Who benefits from it? In order to service that mortgage in Australia, both Australians, irrespective of what your version of a relationship is, will need to be working.
Correct. And what do they need to do when they work?
Yeah, they've got to pay tax. They've got to pay tax, right? So we're trying to do both things now. This idea of like a home in the suburbs and this dream with one working and all that sort of stuff, it's very, very few and far between. That's their version of reality. So what's all this mean for property investors, right? And this is the great irony. You know, you're getting all these people set up for these problems. I think this 5% deposit scheme, and I think we're 1 month into it now.
Yep.
And this is sort of
recording this end of 2025.
What's making property news at the moment.
What's making property news?
I think the October numbers were probably going to go somewhere between 5,800, 5,900 people subscribing to the scheme in the first month.
Yep.
Right. Treasury modelling at the point of time when this expanded scheme was introduced said over a 6-year period it would have a positive uplift in property prices by 0.5%.
Yeah.
I don't think it's going to play out that way. And when that was handed down, we all went, no,
nice
that's not the way it's going to work.
That report probably cost a bit of money as well, by the way.
So the government is in a very difficult position right now. It's in its second term. Inflation data has come out, which is not painting a good picture of smart fiscal management. Inflation is going up. And one of the reasons why, which is banded around by economists, I'm not an economist by any means, is that the removal of some of those electricity subsidies has pushed inflation up and costs around housing has pushed inflation up. And the government now is looking down the barrel of a very difficult 2026 where they're going to have to explain to Australians why inflation is going up and therefore interest rates aren't coming down, and the potential for interest rates staying stable all year, if not potentially going up next year. So good luck trying to sell that, right?
Yeah.
And then you put that in the context of a few years into this promise to build 1.2 million houses by sort of the middle of 2029. We're already 70,000 properties short of that. I think dwelling approvals in October period was down sort of 6.4% to about 15,000 nationwide. So we're not even approving enough. So we're pumping the demand side with negative and inverse supply side. And developers, you do bits and bobs in and around that. Developers don't want to develop because there's just no money in it, right? You're better off just chucking your money in established property and just sitting around and waiting until the things change. And I can't see it changing at any point soon, rapidly and structurally in a way which is going to be meaningful.
No, and I think if the main thing that would make it more relevant, or probably the thing that would move the needle at this stage, is two main things. And I talk about I'm not going to go into too much, but obviously the incentives for people to develop property in a way that's going to be less tax for a period of time would make common sense. The other part is, and I don't expect it's going to happen because it's probably not going to attract the votes, is migration. Yeah. And, we've talked about we're essentially still tracking at very high levels of migration. We went through a couple of years of record migration. Ultimately, we need, if we're going to build more property at a price that's going to make sense, more people would help that if they were skilled and they were targeted as far as we need these, and these people. Yeah. And we bring them in and we get them straight to work in the spaces that they needed to be here. We're at that point where that's unlikely because, that's on the nose. And ultimately what that also does immediately is puts more pressure on housing in the very short to immediate term, because when people arrive, they need to live somewhere. Typically, they're going to be renting for a minimum first 2 or 3 years, and that pushes up rents. And we've got this systemic issue that sits there. And I guess above all, which is the capital city by value segment conversation, is that is also still playing out. We've got this bottom 25 percentile market more or less across the country outperforming the middle 50 percentile and the the top 25 percentile. And that's not a coincidence. It coincides with the first home buyer 5% deposit scheme. It coincides with the affordability constraints, and it coincides with where the majority of people can afford to buy their first home, downsize, and also investors. So we've got this market segment that is well and truly outperforming. We expect it's going to continue to outperform. Houses outperforming apartments slightly, but is still doing really well in both cases. And in most markets, when I say most markets, we're seeing that the housing values rose by circa 1% in October, and they're on track for somewhere in the vicinity potentially towards, in some cases, 9, 10, 11, 12% for the year. Perth, Brisbane, Adelaide, well and truly beyond that.
The immigration is a key thing, and I saw a report in the paper I think it was yesterday or something or other. There's 50,000 student visa refusals awaiting review by an Australian. This was in Senate estimates or something or other, right? So 70% of international higher education students said migration was a key factor for choosing Australia as a place to study. So this is one of the issues that the Australian government needs to grapple with, right? The education system here in Australia, particularly higher education, is fueled by, it's a big economy, right? And the universities take the dough because they can put it to research and keep their rankings and do all that good work, right? Most people that do that come here 70% because they actually want to stay in Australia eventually, right? So they come over here on the basis of doing a degree, and then they refuse to go home. Yep. So they go, oh, no, I refuse to go home. And the Australian government goes, I'll put you on a bridging visa. Yeah. So you got all these people sitting around. So you got all these new students coming in every year to start their thing. And the students that graduate aren't going out the other side, right? Yeah. So
I mean, and I mean, to not sound,
I'm not being
too
xenophobic, by the way.
No, but and I guess there's obviously a big benefit to that as an economy, right? Like these are educated people who come out with a degree and typically go into the workforce.
I think the problem is that they're saying the quality of education providers ain't great in Australia, and most of this is just like we're not actually creating skilled workers through this scheme.
We're creating bridging visas.
We're creating bridging visas.
Yeah. And this is why, like, you sort of the argument then switches to saying, do we need more students, or do we need the people who get past that point and actually have a trade, a ticket, a degree, and saying, look, here's what we need to target. And this is migration 101. Yeah. We know where the jobs are needed, and it doesn't take a genius to figure out if you want to go and hit 1.2 million properties in 5 years, you're going to need to build a lot more property than what you already have. Approvals are down, so you need to get the people in to be able to build it at a cheaper rate, bring down labour costs. It's slightly increase the unemployment rate, which is going to soften that, and this is going to help the inflation conversation as well. I feel like we're going to go around and round here, mate, because there's
so what does all
many
mean for property investors? The great irony is that if you're a property investor, it all probably bodes well for price growth.
It already has this year in particular, and it will next year. Even if we see rates sit flat, even a slight increase next year, there is so much headwind that's sitting there. The trajectory is already sitting. The tailwinds are there. Yeah. We're there. So I expect we're going to be well above average growth for 2026 already.
Yeah. And I don't know if you saw that SQM report coming out, and they do it every year with the
boom and bust.
Four different sort of cases. I think the most favourable tailwinds, I think it had sort of Perth at 16%.
Yeah.
I think Adelaide was about 14.
Well, mate, they're going to hit similar numbers to that this year. I mean, I've got some very happy clients who have bought, we're on our 5th year of well and truly double-digit growth in those markets. Brisbane's the same. Adelaide's the same. There's a few markets that are starting to turn. In particular, Melbourne grew by almost 1% for the last month alone. Got some markets that have been depressed significantly, and they're really starting to show that they're kicking into gear pretty heavily. So there's a lot of scenarios out there right now that we're seeing some very, very significant increases.
So the data is indicating that the bottom quartile, so the bottom 25% of properties by value in each of in those capitals that you mentioned, are outpacing growth in the 50% quartile, the top 25% quartile.
Correct.
The only outliers are Sydney and Melbourne, where
it's pretty close.
The 50% quartile is performing better than the bottom 25% quartile. However, it's marginal. But all those other areas, the inverted commas more affordable properties are growing faster than other properties, and that would be, again, pretty simple to work out. You've got a lot of investors operating in that space.
Owner-occupiers as well.
First-home owners operate as well.
This first-home buyer deposit scheme is going to push this even more.
Yeah, and we saw coming out only just recently, APRA is sort of tapping the brakes on high DTI loans. And again, this is debt-to-income loans. And again, this is one of those ironies where you're offering 95% loans to people.
I know.
Which just, if you're doing that in Sydney, inherently, they're going to be high DTI loans.
Of course they are.
You sit there and just scratch your head and go,
This is it. When this came out, mate, I'm on a couple of different property chats with just professionals, and literally that was the first thing we all just posted together at the same time. You're offering a 5% deposit scheme, and then all of a sudden APRA also tapping the brakes to say, if you're over 6 times borrowing capacity as a non-first home buyer, as an investor, only an investor, then we're not interested in you. Yeah. We're going to tap the brakes there. But you, if you want to go and buy your first home at $1.5 million in Sydney with 5% down, $75,000 cash, and take out a 95% loan on that, we won't give you LMI. We want you to do it. And the banks don't have any issues with saying, give you all the money.
Yeah.
But you're the one who has to make the repayments while the investors are there buying affordable property, creating supply. It's just hilarious.
But then now also, to add to that, this new, I think it started in February, this shared equity scheme.
Yep.
Where the Australian taxpayer now, Phil Tarrant, Paul Glossop, we're taking fractional ownership as an Aussie taxpayer in other people's homes they live in. Like, you just sit there and just go, oh, guys, it's, this is the demand bit, Well, what are you going to do about this supply thing? So, if you're in the market, you're okay.
Happy days. Happy days. Merry Christmas.
How do you feel about that?
But I feel the same way I felt the whole time, where I'm agnostic to it all, because it's all noise, and it will continue to be noise. And I think for me, this is why we constantly reiterate. I mean, the question comes all the time: is it a good time to invest? Is it probably maybe hold off another 6 months? It looks like interest rates might not be going down. It's irrelevant. It's irrelevant. And I don't say it flippantly, just saying buy just because you can buy, but until you show a set of data that's going to say, hey, the next 5 to 10 years looks completely different to the last 50 to 100 years, then I'd say maybe consider pausing for a bit here, because there might be some things that we haven't seen before.
Yeah, the bureaucracy, government, parliament, public service, everything like that, every decision they makes them more invested in ensuring the integrity of the property market in Australia.
Correct.
None of this that's going on right now is a backward step. It's a forward step that they are even more invested in the fact of ensuring the stability of the market and it's working in the right way.
Yeah, it is.
So you've got a pretty big partner to have is the system.
Absolutely. There'd be filibuster to the cows come home to try and smooth it over to say, we want to target affordability, using this word affordability. It's never going to be a direct outcome of this. Affordability will continue to get constrained because it pushes more people to home ownership. Home ownership's good for tax receipts. It's good for superannuation funds. It's certainly good for the banks.
Yeah, it's good for everyone. So I'd put my money in shares.
You would, or you do?
I would, instead of property. Safer bet.
Safer shares.
Safer bet, I'm told.
You
get a better return.
Yep.
And this is the age-old conversation. You paint this picture of the property markets, and if you're a property investor, you need to have a relationship with property. You need to understand the nuances of it. But the point being, if you look historically, it's performed pretty well.
Yep.
In average levels, yes, there's peaks and troughs to it, much like the share market. And you must get this a lot, and I still have these conversations regularly around, well, I'm sort of torn even personally between, I should have a diversified. I've got a very diversified portfolio,
You say you do, or you should?
I do.
Okay.
Business and property and all this sort of stuff, right? But, I'm pretty light on shares.
Yep. As a percentage.
Yep. And one of the reasons why I invest in shares is just a little bit of diversification and keep me at least a little bit connected.
Scratch the Westy itch.
Yeah, scratch the Westy itch. Better than playing the what is it? The builders, the builders laptop. Is it?
The Brickies laptop.
The Brickies laptop. Brilliant.
Nah, the Brickies do a great job.
Brickies do a great, mate. To tell you what, I'd be a brickie right now.
Oh, mate.
Jesus Christ.
I'm looking at buying some bricks. I'm building a house out of bricks very soon, and I'll tell you what, bricks aren't cheap.
Bricks aren't cheap. What's a brick cost now?
Well, I've looked
you be
at
getting
some,
fancy.
So
bricks,
they actually. I got a sample delivered to the house the other day, and
it's 3 times the cost to lay it than what the brick's worth, right?
Yeah, I think it was a couple of bucks a brick to lay it, and they've got these extra long, thin profile things, and man, I tell you, it's a scary number.
So, shares over property. Now, I'm not in any position to provide any guidance on how you should be structuring your portfolios. You need to speak to, the relevant professionals around it, financial planners, accountants, all that sort of stuff. The cabbie. Can't speak to your good cabbie. Or Uncle Ben. Uncle Ben at the Christmas bar. Uncle Jimmy. Yeah, he knows all about it. But I just want to get stuck into this age-old question around where do you park your dough? And you give me a really good graph here, which is essentially a 20-year comparison of the performance of your money should you park it into different asset classes, and different asset classes being the share market and then also property markets and the different actual capital cities, and then for simplicity, the Dow Jones and also the ASX 200, right? There's
so assume you get an ETF that covers the entire Dow Jones and the entire ASX 200 over the last 20 years.
So this is assuming you got 80 grand cash money, and you put 80 grand cash money direct into the share market in those vehicles you mentioned,
and
ETFs,
reinvested the profits,
didn't take anything out, just reinvested the dividends straight back in.
Everything goes in.
Everything back in. Versus that same 80 grand as a deposit, 20% deposit in Perth, Adelaide, Brizzy, Sydney, Melbourne, Hobart. So therefore you're assuming a 320K purchase price. And these numbers are a little bit blunt because it doesn't consider the cost to hold the property with negative cash flow and all the benefits you may get through some negative
tax
gearing,
and rental income as well. Yeah.
So what's the washout with all this fall?
So this is where I look at it, because I think this question is becoming more and more relevant to me these days, because there is a lot more people buying through an SMSF as well.
Yep.
And I think inherently a lot of people do ask this question about their SMSF or their super fund. And again, look, this isn't financial advice, but this is a question that you get as far as saying, well, if I ploughed my money or left my money to multiply over my working career and I left it in an industry fund, assume the industry fund's going to get basically what these major indices are going to be delivering on an average. Now, the Dow Jones during that time delivered an average annual capital growth of circa 9%. Great number. I mean, 9% is certainly nothing to shy at. And that obviously factors in COVID, it factors in the GFC as well. So this factors in good times and bad times, right?
Yeah.
And there's certainly been that. And it happens time and time again. The ASX in that same time delivered about 7% cash on cash return, compounded average annual capital growth. Again, a good number. So 80 grand invested in 2005 left in each one of those two investment vehicles. Let's assume you bought an exchange traded fund that just stayed there for 20 years, an ETF that covered both of those indices. 465% return in the Dow Jones, 286% return in the ASX, or in actual final value, 80 grand ends up being $452,000 in the Dow Jones, and $309,000 if it was in the ASX. And I would dare say there's a lot of people who are listening to this who will probably look back and I dare say that their super funds would probably emulate those numbers quite closely. Now, this is where I sort of say, okay, well, that's one aspect. And this is for private investors who are looking to buy an investment or potentially choose shares, or the alternative is, do I also consider an SMSF, and do I have an equivalent amount for a deposit, set up an SMSF? Could I be bothered? Have I got the right advice? Am I comfortable with it, etc.? And do I take it into my own hands? Now, in that same 20 years, we've averaged out Perth, Brisbane, Adelaide, Sydney, Melbourne, Hobart, Canberra, and assumed that we bought exactly the same price freestanding established house, and we took the average of a freestanding established house and the average growth over that 20 years with a 20% deposit and holding it through that whole time. Now, this is probably what's going to firstly surprise and then also, I think, reiterate the power of leverage, is that in order, the average annual capital growth of each of these markets for that freestanding established house worked out to be in Perth 3.5%, Adelaide 5.2%, Brisbane 4.7%, Sydney 5%, Melbourne 4.5%, Hobart 6.2%, and Canberra 5.5%. In all cases, it underperformed the ASX and also the Dow Jones. Now, that might say, well, why on earth would I put my money there? But the beauty of property is always the power of leverage. And for me, I'm always staunch on saying, unless you have leverage, property, unless it's bought maybe from a commercial net return sense, from a cash flow perspective, it's not really a vehicle that makes much sense once you get down to 50, 60% or below from an LVR perspective, because you just don't get that compounded effect from the leverage.
Your money's better off elsewhere.
It's better off elsewhere.
Yeah.
That's kind of where the argument starts to dissipate. So assuming an 80% LVR, which is exactly where we like to be, Perth over that same time, exactly the same time invested at the same time when we're averaging it out now. And this was the worst performing capital city in that time, interestingly, because it's been the best performing capital city in the last 5 years. But it had a 495% return when we look at cash on cash return, or in dollar terms, that 80 grand turned into a return of $476,000. Adelaide, the return ended up being $732,000.
So but this is assuming, so like with Perth, 476, that's the value of the equity.
That's the value of the asset now.
Yeah.
Sorry, that's the increase. That's the increase.
Yeah.
So the net return, let's go down the pathway of minusing out your original $80,000 investment. Your $80,000 returned you $396,000 in Perth.
Your 80,000 turned into 396.
No, total growth was $396,000 in growth. But I'll go back to the column.
Yep.
Your 80,000 turns into $476,000 in actual cash.
Yep.
And in Adelaide, your 80,000 turns into $732,000. In Brisbane, your 80,000 turns into $648,000. In Sydney, your 80,000 turns into $698,000. In Melbourne, your 80,000 turns into $611,000. In Hobart, your $80,000 turns into $902,000. And in Canberra, your 80,000 turns into $770,000 return. Now, as a percentage, I'll go through each of those again. So Dow Jones, 465% return over that 20 years. ASX, 286% return. Perth, 495% return on your $80,000 investment. Adelaide, 815%. Brisbane, 710%. Sydney, 773%. Melbourne, 664%. Hobart, 1,028%. And Canberra, 863%. In every single case, every single major market for a freestanding established house outperformed the ASX and also the Dow Jones when you look at a pure cash-on-cash return, stripping out capital gains tax, negative gearing benefits, running costs, operating costs as well, but stripping all that out, it is becoming pretty evident that if you're leveraging and you're just playing out averages, and each one of those major capital city markets have had great 2 or 3, 4, 5 year periods, and they've had really average 2 or 3, 4, 5 year periods, every single one of them in that time. And I can tell you, hands down, we've invested as a company in every single one of those markets except for Darwin, which actually isn't in that actual indice either. And I've left it out because the market's so small.
So what you're talking about here, and people talk about leverage. What leverage does, it just amplifies your exposure.
Correct. That's
and
it.
That's all this is talking about.
Literally it saying.
It means you've got more money in the market.
Yep.
And therefore you're getting more of the upside because you got more into it. Really, really simple.
That's
really,
it.
Really,
and
really,
you also
really
get the downside if you
Yeah.
were to leverage and there was a downside. Obviously, you get the downside risk.
Yeah.
Yep.
Yeah. But what I would also say to this is this notion of liquidity. So that's really nice for the Dow Jones. So this is assuming best case, right? Like, people with money in shares, typically it's, someone preparing for retirement. If you pulled your money out at the wrong time from a Dow Jones or an ASX indice, which you have no control over, that number could look very, very different.
Yeah.
Whereas it's a lot harder with property. You can actually time your exit, where you have the privilege to time your exit without being too market dependent.
You can definitely be more confident that if you're saying, hey, I'm going to sell in 3 to 6 months, the price is going to be circa what it is today.
What it is today. Whereas, these black swan events, right?
This year alone.
Happens, yeah,
So you could have picked 4 or 5 different times where you could look like a genius or you could look like an absolute buffoon.
Yeah, so timing is tougher. If you time it right, the upside is significant. If you time it wrong, structurally, which a lot of the things you have zero control over, it's a lot harder to move the needle with property prices, and we saw that through COVID.
Yep.
Than what it is through the share market. So this is why you need to have a sort of comfort and confidence, and why people say be diversified, right?
Yeah,
because
absolutely.
If it's not the right time to exit your share portfolio, well, at least you've got other things out there that you can leverage in order to, raise cash or whatever you want to do. But you need to be comfortable with debt on this basis. And I was chatting with someone yesterday, and they said, their sister or something or other has got X amount of money from a divorce settlement, right? And he's like, put it in property. And she's like, no, I don't want to do that. I'm going to go buy a storage container.
Yep.
For cash, because I don't like debt and are really worried about it, so I'm going to go and buy this investment because there's no debt against it, because they're not comfortable with debt and therefore leverage. So, and a lot of people in the share market would say, they go, I don't want to borrow. Borrowing's bad. I'll only borrow for my principal place of residence.
Yeah. But I will borrow for principal place of residence.
Yeah. So I like having cash. I don't want any exposure to debt because I just don't know. ... And that's okay. So this is the risk appetite. So leverage is good if you have a comfortable relationship with leverage and you have confidence in your ability to cover any shortfall should it take place. It's not very often, I'll tell you, that a bank will come knocking on your door saying, we're doing a margin call on your property, we think it's in negative equity. As long as you're paying your loan, they'll typically leave you alone.
If you're employed.
It's as long as you're covering a loan, it's all okay, right?
Well,
but
that's it.
You borrow against shares and they'll do a review and go, we're not happy with our exposure here right now. Can we have our money back? Thank you very much.
Yeah, absolutely.
And that happens. Right?
It does happen.
Happens.
And then typically the margin itself as well is, you're talking maybe 50, 60% best case scenario, but there's obviously rates on those that are far higher as well. But your point is that the liquidity and the risk that comes with it, that they're all relevant.
So a cynic would say, well, of course you're going to tell us to invest in property, Paul, because that's what you do for a living.
I do it for a living because it makes sense. And that's how I'd always answer it, is that I do it for a living because originally I was a property investor. That's how I got to this point in life, is that I became a property investor first to then understand that property investment was going to trump all other vehicles when I looked at it from an average basis. And now what we do is help people to do exactly that and make sure that we're getting the absolute outcomes that we can that are going to be above what everything else looks like it's going to be able to achieve.
And we've spoken through for half an hour all the reasons why.
Yeah.
Property markets
doesn't look like it's going to change.
I don't think it's going to change.
No.
Maybe, who knows?
Yeah. We will talk about it. We will keep talking about it. Will we talk about a point in time where it's saying it's probably going to be some bad times ahead?
Well, there will be
some bad times ahead.
But I sit there just going, hey, that's great.
Well, this is it. We've talked about it over the decade that we've been recording podcasts. We've talked about it in different times, right? Yeah. It's funny. I had a meeting yesterday with a prospective client who was grilling me a little bit about what we've delivered as far as returns over the last decade. And because we've bought thousands of properties, we actually do a lot of regression analysis to say, okay, well, on this cohort of properties, we average out every single property purchase price, current value, and actual annual capital growth over time. Anyway, the conversation sort of led to, where's the risk mitigation? And I said, you know what? Ironically, I actually did a webinar with you in April 2020.
Yeah.
Might have been late March or April 2020, if everyone casts their mind back.
Is that when you had the COVID? And
we didn't have the COVID, but we were certainly in other sides of the city, and we recorded it in our rooms because we couldn't get out, and that was peak start of lockdown. Yeah. And then this was where all the hysteria about CBA talking about 33% reduction in property values came out, and all this other stuff that was crazy talk. And we did the 5 major impacts to the property market over the previous 40 years, and that went from the recession back in the early 80s to the high interest rates of 87, 88 to the dot-com crash to the GFC, and then essentially to the Royal Commission, to the banking sector, all these major impacts. And what we talked about was the fact that averaging out all that data, and similar to what we've just done here, averaged it out, what happened in the following 5 years? Well, the average property price went up by 33% in the following 5 years, each one of those major events in Australia. Lo and behold, here we sit again. 5 years later, Phil, ironically, and this was unscripted, we're 5 years after that day, more or less. And here we are, property prices have done in excess of that since that time. But again, there is going to be blips, there's going to be changes, there's going to be amendments, but prices continue to increase.
It's a gift that keeps on giving.
Oh.
Don't hate the player, hate the game.
Is that going to be the title to this podcast? Let's make it. It's done.
But
Don't
it's
hate
true.
the player, hate the game.
You've got to have situational awareness. This is what's going on.
Yeah.
Therefore, what am I going to do about it?
Yeah. I'm either going to complain or I'm going to take part.
Yeah. You can sit on the sidelines and talk about all that's wrong with the world and all the societal challenges we have around house affordability, and I do know that's significant, and people smarter than me are hopefully trying to work that out. But that said, I'm not the brightest bloke around, but I can look and go, hang on a second, something's happening over here. It's called investing in property.
First home buyer deposit scheme is probably not a good idea if you want to keep prices capped. Yeah, I'm not the smartest bloke in the room, but that doesn't seem right to me.
Well, I say to folks down in Canberra who tune into this, like, when you're having your next economic roundtable or some sort of committee,
bring us in.
Bring us in. Happy to contribute. Happy to contribute as an independent, impartial observer.
Oh man, could you imagine?
Yeah, I've actually sat in some things down there. It's quite entertaining.
Is it entertaining or is it head shaking? How disassociated do you feel that they are when you're hearing these conversations happen from time to time?
See, one of the problems we have with politics in Australia is it's governed by its own culture, and that culture has changed a lot. You haven't got Billy Hughes, from World War I standing here yelling and screaming on the back of a truck, fighting with blokes.
Bring back the soapbox.
Yeah. You just don't have that anymore. It's got its own culture, and they play their own game, right? It's a cat and mouse game, politics, and and all they're thinking about is being re-elected. It's always the next election cycle, and we don't think. We this is one of the greatest challenges with Australia. We're not thinking generationally. We're thinking the immediacy of this stuff. But it's got its culture. It's got its own way of operating. It's going to be very, very hard to change. And you've got this parliament, which is, it's elected officials, and we have a democracy here in Australia, which some people think is the purest democracy in the world because everyone has to vote.
Yep.
Preferential voting, maybe, but so everyone gets a voice to decide who's in charge, right? But then they go into this vacuum of how all that operates, and they fight and debate around stuff which most Australians don't really care about, or it doesn't really matter that much, right?
And they
most
don't get
people
to see much of that detail.
They don't see, and those people scratch their heads going, well, why even care about this thing, right? But then you've got this sort of bureaucracy, this public service that supports all that stuff. So, the system says that they should be putting these committees together with people with PhDs and other really, really smart people. Often the people that should have the greatest voice aren't represented in those things.
Yeah.
And often because of the very nature in which and how that system works, they don't want those people there because they don't understand or appreciate how it should actually work. Politics would benefit from mixing it up a little bit and sort of shaking it up a little bit and making it a bit sort of raw and authentic again, rather than just smart people with legal degrees. Mate, go and have a look at all the MPs, right, in the lower house. They've all got
all of them.
Yeah, they've all got legal degrees.
Yep.
They're all in the debating club.
Yep.
I'm not being nasty politicians. A lot of them I know quite well, right? But they're all
the ability to be able to understand the average person, it's limited by the virtue of how they've been raised and what they've done in their lives, and not to their fault.
They're all staffers.
But I tell you,
right?
one thing I look at personally, and one level of government which I think actually probably needs more autonomy a lot of the time, and there's a double edge to this sword, but that's the local government. Yeah, because that is the bastion of people can get stuff done. They've got a pot of money typically, and there's demands from
a lot of them are still going broke though.
Well, this is it, right? Because this is where you say, well, the argument will be, can we just get people to go out there and get stuff done without having to sit in that room and have that conversation, and then go to a vote, and then go through different levels of Senate and lower house, upper house, etc. Well, if we didn't have that, then you can potentially get lucky and get a good local government with a good leader and a good group of people around it and go and get stuff done immediately because they have cash and they have no one in the way. But with that becomes all of the other challenges, corruption, spending money on areas. And then you say, well, it's just the ultimate balancing act, right? Like you can't give too much power to one segment or give too much money to the other. There is certainly, over time, we've built this 250-year democracy in the way that it has, and it's doing pretty well.
Oh, you wouldn't want to be anywhere else.
This is it.
I'm not being critical here, right?
But again, like I think sometimes just being honest about the fact of saying, we're going to try and get to 1.2 million, but the reality is we just want more people to take out more mortgages because it's good for the bottom line. And what that means is that we get more tax dollars, and then we can benefit more schools, more hospitals, we can better the universities. And then also, you know what, the banks benefit, and then all of a sudden your superannuation goes up. That's why we want to do it.
Tell us
Tell us why. Tell us, be honest. Yeah. And I'm not getting in your way because I get it. I'm benefiting from this. Yeah. You're benefiting from this. We all benefit from it if it's done in a way that is working for most people. But sometimes transparency is everyone's trying
their best, and most pollies, like, they're highly committed people. They compromise a lot of things in their lives to do what they're doing.
It sucks.
Politics is a calling for a lot of them, but again, they've got their own game.
Yeah.
And that's how it's played out. So, geez, we waste some money sometimes, though.
No, we definitely do that.
We certainly
Talk
waste
about
some money.
Bureau of Meteorology's most recent upgrade to their website.
Someone just went, hey, mate, I could
$96 million.
I was watching someone saying, mate, I could have rebuilt that in a day using AI.
Absolutely.
A couple of Red Bulls.
They're the things where I'm like, mate, that's where you're just like, no one's going to be held accountable.
It's governance sort of stuff around it, which you need good governance. So look, it's largely all pretty good. And shout out to all those politicians doing great work. But God,
get the wind forecast right, would you? Yeah. Without spending $96 million.
Yeah. Anyway, well, that's the Pure Property Podcast. You guys around over Chrissy?
We are, mate. This is
when people actually sit and go, oh, I better start doing something.
Well, there's a lot of that. Yeah. There's a lot of people actually saying, oh, I should start doing something. And also there's a lot of people actually saying, I've got to sell and I've got to do it before the end of the year. For whatever reason, arbitrary numbers, people bring up calendar dates. So the answer is yes, we are flat out. We're working right up
like a lizard drinking?
Like a lizard drinking.
Great.
I was going to go down a different way there. I was like, that's not going to work. But we're shutting down literally the day before. Was it the day before? Not the calendar dates aren't really marrying up to me. I think Christmas is a Monday or Tuesday this year.
Could be.
Yeah, but we're working right up to that last weekend there, and we're back pretty much straight after New Year's because times are ticking and we're flat out. So yeah, if anyone wants to catch up with us, they will always have an opportunity. They can lock in a time, purepropertyinvestment.com. They can book in a time immediately. They can give us a call, 1300 98 5428. And for me, this time of year, is that if you're thinking, oh, it's not this year, it's next year, book in for next year. Book in a time with us for sort of that late Jan, Feb, when you've got a bit of time to take stock and then put it in the calendar.
Hold yourself accountable.
Absolutely. It gives you a bit of time to prepare your numbers, get ready and say, okay, well, I'm going to start them with a bang. February is the time I'm going to start. And then ideally by this time next year, what we expect is probably going to be circa 10% growth year next year would be your 10%.
All over the joint?
I think it's going to be a lot more level compared to the last 4 or 5 years where we've seen some markets do 20%, others do 3%.
Yeah.
I think we're talking a lot more of a broad base uplift and a lot less of those 20%, but also a lot less of those 2 or 3%.
All right. No, thanks for the insights. The conclusion is you can sit around and debate all these things around, and draw parallels and discuss them around what's happening in property markets. None of it really is in your control. So what you choose to do about it will give you bearings for how successful you are. So you can either sit on the fence and do nothing, or you can take action. And property investment favours action takers.
Absolutely.
Just the
action
nature of the
takers
beast.
and decision makers.
There you go.
That's it.
There you go. Purepropertyinvestment.com. Go and check it out. The team will have a chat with you as you sort of embark on planning for 2026. Get stuck in. I think it's going to be all right. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.